Very good evening to all of you. Welcome to today's practical session, which is session number 13 for the year 2024. Myself, Srijit Kakkar, and today is Sunday, 31st of March 2024. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. So today's session is again our practical application of demand supply methodology. So I'm pretty sure that you people would have gone through the course. Now the demand supply course used to be a paid course some time back, but now it is available as a free course to everyone. The links are available in the description. In case you have not yet taken the complete course, you can take the complete course. You can understand the methodology, how to apply it theoretically, and in these sessions we'll get into the practical application of the methodology. So let's get started. So we don't have anything which is pending for review, therefore we can straight away start with our analysis. Now, when it comes to demand supply, in fact, even if we talk about broadly trading, I always say trading has to be a very mechanical and rule based process. Now, why it should be mechanical and rule based, I have explained this in a video, and the title of that video is How to Start Trading. The link is available in the description. Again, during the session, if I talk about some videos or if I'm talking about some documents, all the links are available in the description. Just look into the description, you'll be able to find it. Plus, I'll also add that the course is available in both languages, English as well as in Hindi. And similarly, these practical sessions I do in both the languages, English as well as in Hindi. So this is the English session. If you are more comfortable in Hindi, then just go into the description. You can find the link to the Hindi channel as well. So yes, like I was saying, trading has to be mechanical rule based, for which I've already created a video which will help you understand why you need to be mechanical and rule based. And the process that I've explained in that video is very, very important. Eventually, everyone will have to go through it. So the sooner you start, the better it is going to be for us. So since we need to be practical, we need to be mechanical, we need to be rule based. When you're starting with learning trading or when you're starting learning a new methodology, the very first day, it's very challenging for us to create a trade plan because of the lack of experience in that particular strategy. So what I've done is to make this easier for you. I have created two documents. The first one is called as the trade plan steps, which is basically the walkthrough, or you can also call it as the flow chart. This guides us what we need to do as a demand and supply trader step by step. Now, all these steps, they have their own elaborate rules, which are available in the rule book. The rule book is a conservative approach. With time, with experience, if you want to make some modifications to it, to make it better suit with your personality style, yes, those modifications can be done, but at least you people do have a starting point using which you can start planning your trades very mechanically, very rule based. So what is our step number one? Whenever we start planning our trade, step one is we need to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose implies the expected duration of the trade, which means from the time I enter the trade to the time I exit the trade. How much duration am I expecting to remain in that particular trade? So that is what we call as the trade duration. And then I'm talking about the exit here. The exit can be the target, the exit can be break even, the exit can be the stop loss, the exit can also be the trailing stop loss, any kind of exit. So now the question is, why are we starting with the trade purpose? And the reason for that is when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge is there are so many time frames available. Out of these n number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frames. We start by first defining our trade purpose, because logically, the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into four different purposes. We call them as hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, when you're trading markets which are not 24 hours market, I'm pretty sure all of you would have experienced whenever the market opens, some stocks or some symbols, they gap up, some they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that particular trade. So this is why my recommendation to all of you is that initially your hourly dailies should be done strictly as intraday trade. Do not take unnecessary overnight gap risk. For weekly monthlies, anyhow, you're not anticipating that we'll get the exit the same day. So here you have no choice but to keep them as overnight trades. But the good thing is when you're planning your weekly monthlies, you're leaning against some bigger time frames. So the probability of that gap against you definitely reduces, but that does not mean it cannot happen. It can still happen, but the probability goes down. So again, initially hourly dailies, intraday, weekly monthlies, overnight. With time, with experience, if you want to include daily income into overnight trades, that can be done. But early on, as a risk management rule, my recommendation would be only weeklies, monthlies as overnight trades. So let's assume I opted, I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen from the rule book, I'll get to know what time frames I should be using. Now, demand supply methodology is not based on one single time frame. Demand supply methodology is based on multiple time frame analysis. So, what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supplies for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Next, what are the four different purposes of trades? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now, mind it, this table is for NSE, which is open for about 6 hours 15 minutes. But if you're trading markets which are open for longer duration, then you can refer to the table which is available on page number 32 on the rule book. So because I opted, I want to plan monthly income trades. From here, I got to know that my time frames will be monthly, weekly, daily, and 60. Out of which monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate used for trend analysis. Daily will be the lower time frame. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. As a monthly income trader, our refining time frame will be the 60 minutes chart. So as soon as I'm done with my step number 1, just a second. Right, so as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Next comes challenge number 2, and that challenge is, yes, I do know my time frames, but let's say if I'm looking at the NSE market. So on NSE, we have about 2000 plus companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So I need to have a process in place now which can help me get a smaller list out of these 2000 companies, because if I have a small list, I can do my analysis almost every other day. But if I have to analyze 2000 companies every day, not an easy task. Now, very important, always remember, irrespective which scanner or screener you're using, whatever results you get, you can never blindly buy or sell those stocks. And the reason for that is the job of the scanner is not to tell you what you need to buy or sell. The job of the scanner is, I can't analyze such a big number. Help me get a smaller number. So once I have a smaller number, I'll have to manually analyze all of them and check which one of these matches with my trade plan. The one that matches with my trade plan can be my opportunity. One does not match with my trade plan, we simply skip it. So very important that uh, always keep this at the back of your mind. Scanner screeners are not giving you ready-made opportunities. They're just helping you get a smaller list out of a bigger list. Now, a few examples of these scanner screeners. Example 1, if you go to my website, you will see under the free tab, I have created some scanners for you. And these scanners are based on some moving averages. They can help you get a smaller list. Second example, if you search on my YouTube channel scanner, you'll be able to find a few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll be able to find a video on top-down analysis, which can again help you in shortlisting symbols. Now, again, these are 3-4 different examples, but you're not restricted only to these 3-4 different scanner screeners. Let's look at few examples before we move ahead. So like I was saying, once you come to our website, under the free tab, you have stock screener, and we have all the 4 trade purposes available: HIT, DIT, WIT, MIT. So let's assume I wanted to plan a MIT trade, so I can run the long scan and the short scan. So here you can see the long scan is shortlisting 4 symbols for me. So like I said, just because I'm getting these 4 symbols in the long scan does not mean I can blindly buy these four, right? So always remember, the scanners, they don't tell you what you need to buy or sell. They only tell you, okay, out of these 2000 companies, just analyze these four. Out of these four, if anything matches with your trade plan, it can be your opportunity. If it doesn't match, you don't have anything available. And if I go to the short scan, you can see it is not shortlisting anything for me. So this can happen many times that nothing is matching with these conditions, due to which you don't get a list, or maybe your list is a very small list like you can see here. Or even otherwise, if you want to have a little bigger list so that you can analyze more number of symbols to identify your opportunities. In such case, you can see that I've given 5 different conditions here. Just disable the third one, run the scan again. And I'll do exactly the same thing here. Disable the third one, run the scan again. And now you can see initially I was having a result which was just about 4 symbols, but now it is giving me around 83 from here. And if I look here, we have 14. So we have 83 plus 14, which is it 14? Yes. And if I go back, it was 83, correct. So we have 83 plus 14, which is 97 symbols to look into. So you can see that out of 2000 plus companies, I was able to get a list which is just about 97. Not a very big list. It can easily be analyzed, I'll say probably in half an hour, 45 minutes. But let's assume you feel that this is still a very big list. You further want to filter it out. You can use different filters. You can say, okay, I only want the ones which get traded in futures. I can run the scan again. I'll do exactly the same thing here. I don't want from cash segment, only the ones which get traded in futures. And now you can see I have a list of 24 plus 7, which is about 31 symbols to look into. So you can see from 97, now I'm down to 31. If I further want to make it smaller, maybe I can select only from my Nifty 50. So choice is yours. How big or how small you want your list to be based on different filters. Plus, this is not the only screener available to you on this website. You can see if I go to the screener section, you have over 150,000 screeners available on this particular website. Some based on fundamental analysis, top love, candlestick patterns. Then you have your range breakouts, bullish scan, bearish scan. Then you have your intraday bearish, intraday bullish crossovers. So you have a number of scanner screeners available to you. And this is example of one website. Similarly, if you'll do a Google search, you'll find a number of websites, a number of scanner screeners available to you. Whatever you feel is the right fit for you, you can use that scanner to get your smaller list. And like in this example, you saw we got a list of about 97 symbols. Now, once you start analyzing them, just give me a second. All right, so once you start analyzing them, there are few challenges which you will realize. Challenge number one, that you will see that out of these 97, most of the symbols, they don't have any quality demand zones or supply zones on the lower time frame, which means you're wasting a lot of time analyzing such symbols where nothing is available, which is more like a tradable zone to us. And the reason for that is that all these 150,000 scanners that I showed you, none of them are based on demand supply zones. They are either based on conventional technical analysis or fundamental analysis. And the second challenge is that even if you have some zones, they can be far from the current market price, due to which you might have a longer waiting period before the prices are back, and whatever price action develops during that waiting period, it might eventually disqualify that trade setup for you by the time prices are back. So these are some challenges that we face. And to overcome these challenges, I've also created two custom build tools, which we call as the alert service and the screener. Now, minded, these are not call giving or tip giving services. These are also scanner screeners, but they are based on purely demand supply zones. Now, the walkthrough videos for both of them are available in the description. You can go through those walkthrough videos to understand them better. But just to quickly help you understand how these two, they basically work. So what you will see is here that I have a screenshot from 28th of March, and this is from the demo channel. So we have demo channel for NSE, we have demo channel for Forex, we have demo channel for MCX. So what happens is, on the demo channel, for half an hour in the day, we give you alerts as and when the zones are getting formed. So here you can see we got an alert at 11:15 that on Jubilant Food we have a rally based rally zone on the 5 minutes time frame. That's the proximal value, that's the distal value. Then again at 11:15 we had an alert on Gale, we had our trend, and this was on 5 minutes, this was on 15 minutes. Then you also have your zones from the daily time frame. Then you can see at 11:20, 11:20, 11:25, 11:30. So you can see as and when these zones are getting formed, alerts, they keep notifying us. So what is going to happen? The first thing is, the only reason you're getting these alerts is because you have a formation of a zone. So challenge number one is taken care. You will always have a zone, and that is the reason these alerts are getting generated. And since these alerts are generated as soon as the zone is completed, which means the leg out is completed, your current market price will always be close to the zone. So that's how alerts they work. We also have, like I said, the demo channels. If you want to join it, you can join it, you can experience it. The other one is the screener. Now, just to show you an example of how screener basically works. So in screener, what you do is you give your list of symbols. Like here, you can see that in the screener, I've given a list of about 40 symbols. And what I've said is that based on the proximity setting, 2% out of these 40 symbols, identify the symbols which are matching with these conditions. So now if you think about it, that if I was manually going through 40 symbols, I had to go through all those 40 symbols to see where I am trading close to the demand or the supply area. But now you can see out of those 40, it has shortlisted 1, 2, 3, 4, which are close to supply, and 2 which are close to demand, which means now my analysis part is only analyzing these 6 symbols. Other than these 6, I don't have to analyze the other 36 because they are not close to any demand or supply area. So just as an example, if I go to Hindu Unilever, you will see that it will be close, trading close to a demand zone, and because I'm on the daily time frame, it is telling me for demand. So can you see that's where you have your demand area? And if you will look at this demand zone, this would be within 2% of the low of this candle, because that is what our setting was. Now, this is an example, let's say, where I'm planning an MIT trade. So as an MIT trader, daily is my lower time frame. So I'm only trying to identify symbols which are close to my lower time frame demand and supply zones. Now, another example can be, let's say I plan WIT trades, and I only plan trades at the best location. So out of these 40 symbols, I want to know which symbols are trading inside a weekly demand or a weekly supply area. So in such a scenario, I can change my settings. I can say, first thing is, because I want to be inside, so I don't want the proximity method using high low, I want it using the close. And because I want to be inside the zone, which means the zone will be tested, so I want the screener to use tested zones for me. And plus, since I want to be inside of the zone, this has to be 0, right? 0%, because now the proximity has to be 0%. And if I change it to weekly, you will see it will give me a list of symbols where the current candle will be inside of a demand or a supply area. So again, you can see I don't have to go through 40 symbols. I know these are the 6 symbols. 4 where I am inside of a supply zone, 2 where I am inside of a demand zone. So just as an example, let's say if I go to TechM. So here you can see TechM will be trading inside. You can see I'm inside of a weekly demand area. So that is what the screener basically does, that based on whatever settings you're giving in, out of that list, it will give you a list of symbols which are matching with those conditions. So again, all these scanner screeners that I talked about, it's not that they are mandatory tools, they are all optional tools. This process can be as simple as, I don't want to use any of these scanner screeners because I want a small list. I will only be analyzing my Nifty 50 stocks every day. It's your call how you want to get that small list, but I've just showed you a number of tools that are available to you. I showed you over 150,000 scanner screeners which are absolutely free. Then I also showed you two which are purely based on demand supply zones. But yes, these are definitely subscription based tools. But again, like I already said, choice is yours how you want to do it. Obviously, the more your scanner is inclined towards demand supply, the higher will be your probability of finding opportunities. Plus, with spending less time into analyzing these symbols. So your call how you want to get it. And let's assume we got a list. Now, once you got that list, the next step is to go to the lower time frame. So the question is now, what is my lower time frame? We got the answer from our step 1. That as a monthly income trader, lower time frame is the daily chart. So lower time frame here implies daily. So I need to go to the daily time frame on whatever was the very first symbol. So let's go to the chart, and what we need to do on that chart is we need to identify a zone. So if I go to the chart, so here I do have the demand and supply zone indicator applied. Now, demand supply methodology is purely based on price action. Once your eyes are trained, you will be able to identify these structures. Here you can see, we had a drop, we had a period of pause, we started moving up. That's a drop based rally, which the indicator is marking for us. Now, we also have a few free indicators, which is the boring candle indicator. You can use it for free forever. Similarly, the explosive move indicator, you can use it for free forever. These indicators initially can help you train your eyes to start spotting these areas. And once your eyes are trained, you can even do the analysis without using any of these indicators, but I prefer to use my demand and supply zone indicator because it makes the process mechanical easier and faster. So here you can see that the indicator is telling us that we have a drop based rally structure. So let's mark this zone which the indicator has identified for us. So that's your demand area. So that's your step number 3. Identify a zone on the lower time frame, which the indicator is already doing for me. So do we have a zone available? Answer is yes, we do have a zone available. Now once you have identified the zone on the chart, does not mean you can blindly trade it. The next step is to qualify it, and for qualification we have a 2-step process. Step 1 will qualify it based on certain conditions, and in step 2 will qualify it based on the booster scoring. So the first thing we'll check is that, is this zone a case of level on top of level? Now how do we verify that? It's a very simple concept. Let's say you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. We call it as a case of level on top of level. So again, when your intermediate time frame zone is getting divided into multiple zones on the lower time frame, it is referred to as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to coincide with the intermediate. Only if it is coinciding with the intermediate, it might be a case of level on top of level, but if it is not coinciding with the intermediate, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? Now as a monthly income trader, our intermediate is weekly, and on the weekly you can see we have this drop based rally structure. So let's draw this, and this time I'll use a different color so that we can differentiate between the two. So the one marked in pink is your intermediate time frame zone, the one marked in green is your lower time frame zone. So is my lower time frame zone inside of my intermediate time frame zone? The answer is yes, which makes it as a coinciding level. Now do we have a case of level on top of level or not? Now, when we talk about level on top of level, it is not mandatory that the other zones might be quality zones. So I can change the indicator settings that I just don't want quality areas. I want all demand supply zones. And now you can see we have one zone, we have another zone. So, the concept which I was talking about, that when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level, and that is what we can see here. We do have a case of level on top of level, in which case we should be using the lower level, and that we were already doing by default. So no modifications are required as far as shifting of zone is concerned. But if you have been attending my sessions regularly, you know that whenever I see that we have the distal line of the intermediate time frame a little close to my distal line of the lower time frame, I like to make this modification. And the reason for that is, if I don't make this modification, at times what might happen is, if the prices they go a little deeper into that intermediate time frame zone, I will get stopped out, and then it might start going in my favor. So again, is it mandatory to make that modification? The answer is no. Narrower zones have their own advantages, but narrower zones, they also have their own disadvantages. So I prefer to be a little on the conservative side, which is why I would like to make that shift and have my stop loss below the low of the intermediate time frame zone. So that's the modification that I'll make here. Oops, yep. Let's now draw our 1:1s, 2:1s. Perfect. So coming back to our analysis, it was a case of level on top of level, but no modifications were required. This zone is not because of a gap, therefore gap rules will not apply. It is definitely a structure of pivot or a non-authentic zone, because whenever we see a drop-based rally or a rally-based drop, we always assume it to be a pivot or a non-authentic zone. But as an exception, we don't need to apply the rules of pivot and non-authenticity here. If you go to the rule book, you will see that I've given you a rule which says that in case of level on top of level, there is no need to apply pivot and non-authentic rules, because being a case of level on top of level already gives us that extra probability that we are looking for. So that is why in case of level on top of level, we can skip the rule of pivot and non-authenticity. So this is not applicable, and it is not even a structure of unstable equilibrium. So out of all these conditions, level on top of level was applicable, but we were already using the lower level, so no modifications. And other rules were not applicable. If they are not getting applied, they cannot disqualify the zone. So is the zone qualified for us? The answer is yes. So based on these conditions, it is a qualified zone. Next, we'll do our booster scoring. So if I bring up the booster sheet, first one is freshness. We can see the zone is fresh. After the zone, the formation of the zone has never been tested. Talking about strength, we have an explosive move. That is the reason the indicator is marking it for us. Time at the zone, we only have one candle gets a score of 2. Reward to risk ratio is definitely an assumption. Talking about location, if I go to the monthly chart, so here you can see from my current market price, this is my nearest pivot high. Now the fact is I do have a demand area on the monthly, but I don't have any supply zone. Now, depending upon your personality style, a conservative trader might say, okay, I have demand, but I don't have supply. I can't do my curve analysis, so I'm skipping this symbol. I'll be analyzing some other symbol, right? That's the very first approach. The other one can be, if you still want to plan your trade, and we have seen such examples very frequently in the previous sessions, that I know that this is my most recent pivot high, and from here prices they move down. So logically the only reason for prices to move down has to be some sort of supply, right? It's just that we can't see that structure of supply on this particular time frame. We might have it on some other time frame. So what I can do is I can use this as a reference point to do my curve analysis. So what is going to happen, instead of having 5 divisions, we'll be having 4 divisions, which is very low of the curve, low of the curve, middle of the curve, and high of the curve. But we don't have very high of the curve because we don't have a structure of a supply zone on this time frame. So that is the second approach, that we can still do our analysis, but by taking this recent pivot high as a reference point and drawing our curve. So where are we located? You can see we are planning our trade very low of the curve, and the good thing is we also have the support of the distal line of the higher time frame as well by making that modification. So yes, we are at the best location, gets a score of 2. Now at best location, trend definitely becomes irrelevant. It doesn't matter whether you're in an uptrend, downtrend, or sideways. In all kinds of trend, the trade can be taken with a score of 1. But here we are in an uptrend. But the fact is we could have skipped the trend analysis because we are at the best location where, like I said, trend becomes irrelevant. All right. Next, the move from the zone. We already have a move which is more than 4:1. So therefore, we will give it a score of 2. Talking about level on top of level, it was a case of level on top of level also coinciding. Plus it can also work like a trap, because you can see that if I take a horizontal line here and start pushing it up, almost this area has been working like an area of, if we bring a little bit more history, you can see it has been working like support, working like resistance, working like resistance, working like resistance, working like support, again working like support, again working like support. So we have a pretty clean area of support and resistance, and now we have our zone sitting right below it. So what is going to happen, people who believe in support resistance, they will be buying here with their stop losses, which will be sell orders placed below. Similarly, if you have a breakout, these breakout traders will also sell. So we understand by the time we are into this zone, we'll have selling coming into the market because of people who are having their stop losses, or the people who are doing breakout trading. And these people are making two novice mistakes. Mistake number 1, selling after a decline in price, which means selling at a cheaper price. And mistake number 2, selling in an area where in the past chart has proven to us demand exceeded supply, which could be the only reason for prices to move up. So yes, we definitely have that possibility that this might act like a trap. Therefore, we'll give it a score of 1. So if you look at the overall scoring, we have a score of 10 out of 10 for quality with the assumption of reward to risk ratio, and 8 out of 8 for probability, which makes it as the high quality, high probability trade setup, which can be done as a type 1 trade. Now, one thing which I would like to add here is that I have seen this many times, that what people they generally do is, when they see a score of 10 out of 10 and 8 out of 8, which is the highest score a zone can ever get, they come into a mindset that, okay, this is going to be 100% sure shot winner. So remember, the scoring is not for surety, the scoring is for probability. So the quality is very high, the probability is very high, but it can still be a stopped out trade. So do not ever assume that if you have a 10 out of 10 and an 8 out of 8 zone, it will always be a profitable trade. It can still be a losing trade, which is why risk management is very, very important. You need to do your proper position size calculation. Whenever the prices are back, we'll have to re-verify, since the markets are not static. And if it is qualified, we'll place our order based on the entry type. In this case, it is a type 1 trade. And after your trade has been executed, the next step is your trade management. Step 1, 1:1, we make it as break even. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. And that is how we plan trades, very mechanically and very rule based. All right, so that takes care of the practical example for today's session. Now we'll get into the questions we have in the chat box. I'll take some random queries, I'll answer them. But before we do that, I'll add, if you're liking these sessions, do hit the thumbs up button. If you're not subscribed to my channel, do subscribe, because at times I do reschedule these sessions. So if you're subscribed to my channel and have the notifications activated, you'll get notified whenever these sessions are getting rescheduled. So that you can join in live. Just in case you miss the live session, you can still watch the recording later. And yes, if you have any friends or family members who are into trading, or if you're into some trading groups, you can also share the link to my courses and these sessions on those groups. You never know, it might help somebody with their trading. All right, so let's see what do we have in the chat box. So the first is refining time frame. What exactly do you mean by this, and can you show as an example? So can you see in this example, our refining time frame would be the 60 minutes chart. So as a 60 minutes chart, I can use it for multiple purposes. One example can be I can maybe use it for fine tuning. So if I go back to the chart and I want to fine tune the zone, so what can happen is maybe I might have more zones on the 60 minutes. So I can now fine tune my proximal line from here till here, and I can even have a narrower zone, right? So that's one case where I'm fine tuning my zone. The second case can be, let's say, if this would have been a type 2 or a type 3 trade. So in that scenario, I'll wait for the prices to come inside of the zone, then I'll wait for a bullish or a very bullish candle to form, and then I can take a type 2, type 3 trade, right? So refining time frame can help in many ways. It can help in fine tuning the zone, it can help in type 2, type 3 entries, or in case at times if it is a structure of a pivot or an authentic zone or unstable equilibrium, then we have some rules which we apply on the refining time frame to qualify that area. All right, what determines a zone needs fine tuning? And lastly, do you have any entry confirmation when price is at the zone, or do you just put a pending order straight away? See, again, the way, the answer to the first question, when do we decide, do I want to do fine tuning? It's completely your call, right? Because the reason is, like I said, if you are narrowing down the zone, the disadvantage can be maybe, you push your proximal line here, but the prices touch here and they start reacting, you might miss your trade. So that is something you have to decide how narrower you want your zone to be. And talking about putting the order straight away as a type 1 trade or type 2, type 3. Yes, initially you might want to do it as a type 2, type 3 trade where you're waiting for those confirmations, bullish candle in demand zones and bearish candles in supply zones. But once you start getting good with your zones, what you'll realize is that most of the times prices, they just touch the zone and go back. Due to which, if you're waiting for type 2, type 3 trades or confirmations, you will be missing a lot of trades. So it's again, completely depends on how aggressively or how conservatively you're planning trades. The more conservative you are, the more you'll be inclined towards type 1 entries versus confirmation entries. And the more aggressive you are, then it definitely makes sense that you start looking for some confirmations because you know that you're taking some aggressive trades. All right, grading based upon boosters, you determine whether it's type 1, 2, 3. Apart from no trade part, what action do you take in each? In refining time frame, forget by placing pending order, or is it for risk? So I'm not able to get this query. Let me read it again. So grading based on the boosters, we determine whether it is going to be type 1, type 2, type 3. Absolutely. So apart from no trade part, what action do you take in each? See, type 1 means your trade is already placed. Type 2 means we wait for the prices to come inside of the zone and then we wait for a bullish candle to form, let's say in case of demand. And once I see the bullish candle, I can immediately buy at the current market price because I'm still buying it a little cheaper. And in type 3, when the prices are leaving the zone, after the formation of the bullish or the very bullish candle, then we get into the trade, right? So that's the difference between the three. And when we are waiting for those bullish candles or very bullish candles, or in case of supply, bearish or very bearish, that we do on the refining time frame. All right. And refining and set and forget by. See, only type 1 can be done as set and forget. So I was not very clear what your query your query actually was. So as I was reading through, I just kept answering, almost every part of it. I hope it helps. But if I'm not able to answer it correctly, maybe you can rephrase it and put your question again. Okay, reversal patterns might be non-authentic zones and pivot zones with less than 3 candles. See, again, the fact is whenever we are looking for quality areas, we are always looking for areas where the number of candles are 3 or less than 3, right? So that is why in the rule book it says that if your number of candles are 3 or less than 3, fact is it even applies even if your number of candles are more. But since on the lower time frame, generally we are focused on zones with 3 or less than 3 candles, that is why it has been mentioned that way in the rule book. Right, can we get access to the indicator? So yes, anyone can have access to the indicator, but it is subscription based. So you need to subscribe to it from our website. So once you subscribe to it, whatever commencement date you'll select for it, from that particular date, you'll start having access to the indicator during your subscription period. All right, can you show examples? Let me see. Where you are fine tuning. So I just showed you an example here, in fact, if you look at it the other way around, can you see here, even on the weekly chart, we had a pretty wide zone. Can you see starting from here and ending here? And now you can see the same thing I can say has been fine tuned on the daily, right? I just showed you the same thing. I can even go to 60 minutes chart and further fine tune it. So that is what fine tuning would mean. How to join the demo channel? So once you go through the the link which is available in the description. In fact, what I can do is I can maybe even quickly show you here. So can you see once you come to our website under no, it is going to be a little bit challenging for me to show here. So once you go to alerts, let me just check if it is available there. Just give me a second. Right, so can you see? Absolutely. Even if you come to the alerts page, as you scroll down, you will see here you have the links to the NSE demo channel, to the MCX demo channel, and the Forex, right? So it is available on the alerts page, right? And even otherwise, like I said, the links should be available in the description once you go to the walkthrough of the alerts. All right, let's see what do we have next. What if I'm using the screener or the demand supply zone indicator? Can I use two separate chart layouts with different settings? One layout for DIT and the see, absolutely, the screener and the indicator, they work independently. So like here when I'm using the screener, you can see I have a two chart layout. So the settings of the indicator has nothing to do with the settings of the screener. So screener will be having its own independent settings, and the indicator will be having its own independent settings. And yes, if you have multiple chart layout, on every layout when you're applying it, its setting would be independent of if it is already applied to a different let's say a different chart. So it's not that it's one setting which is applicable to uh, all the charts. For every chart you can have a different setting. One can be for WIT, the other one can be for DIT, the third one can be for let's say HIT. So yes, you can make those changes. All right. Can you set four different layouts, MIT, WIT, DIT, HIT in TradingView if you have a premium account? You up Yes. So I think probably you are answering this to the question which was asked above. Yes, so I can see you're answering to that person. Okay, next, I still having in grasping when you one of the criteria is met, LOTL gap. Okay. When applicable, does this mean that the zone is not valid and thus disqualified? Okay, let me just see. When you one of the criteria is met, that is okay. Now let me just go back maybe to help you understand. See, what we are doing here is when we are looking at these conditions, right? It can be a case of level on top of level like you saw today. Now, being a case of level on top of level or not being a case of level on top of level does not disqualify the zone. If it is a case of level on top of level, we might have to shift from one zone to another. But if it is not a case of level on top of level, does not mean it gets disqualified, right? So we are checking level on top of level just to ensure that if some modifications have to be made, if I have to shift from one zone to another zone, at least I make that shift before I move ahead. Now when it comes to gap, if it is not a gap case, anyhow it cannot disqualify the zone. But if it is a gap, the zone is because of a gap, then we'll have to check whether it is a pro gap or a novice gap. If it is a pro gap, it is qualified for us. If it is a novice gap, it is not qualified for us. Similarly, when it comes to pivot and not authentic, right? If we apply these conditions and see that based on these conditions, the zone is not getting qualified for us, that is where we just simply disqualify the zone and we don't use it. So again, all these conditions are independent, and if any one of these disqualify the zone, then we are not using the zone. It's not that all of them have to disqualify, and it is not even that all of them have to qualify. So some of them might be applicable, some of them might not be applicable, but whatever is applicable, then you have two possibilities, either qualified or disqualified. And if it gets disqualified, you're not supposed to use that particular zone. So I hope that helps. All right. How do you use alerts when using type 2, type 3 entries to ensure you don't miss the trade? See, the fact is, I generally don't do type 2, type 3 entries. But if you talk about type 2, type 3 entries, the only thing you can do is probably you can have your alert exactly at the proximal line. So whenever the prices they cross the proximal line, you'll get your notification. Now, after that, you will have to manually watch and wait for the bullish candle to form. Only then you can place your order. So if you feel that in the alert, I get the alert after the formation of the bullish candle inside the zone, that is not possible. So you can only get your price alert once the prices they enter the zone. Then you'll have to watch it manually. I purchased demand and supply indicator scanner. I am using the free version of Trading View. When marker is closed, Trading View is showing incorrect chart results into wrong results of scanner. So that should not happen. But Vijay, what you can do is, if you feel that there are some discrepancies, you can just take a screenshot and email it to info at the rate Surjit Kakar. My support team will definitely look into it and get back to you, right? Maybe there are some challenges which or maybe some chart settings which you need to do. So you can just send it via email. We'll definitely respond to you as soon as possible and help you fix it. All right, why some zones are not touching opposing zones and coming back? So I'm not able to get your query here. Okay, so are you saying why some of these pivot highs, pivot lows not touching any of the zones and then coming back? Is that what you mean? I'm just making it as a guess, Hari. Now, the thing is, it's not that you need to have a supply on the same time frame. You might have a supply on a smaller time frame somewhere around here from where it touched and started moving back. So that could be the reason. But the thing is, when we are planning trades, we need to have something mechanical and rule based for us, and that is how we plan our trades. But yes, you might have zones on other time frames as well, which might not be visible on this particular time frame. Suppose I find a trap that opposes our expected direction of price. In this case, do I add a point to trap or not? See, when we talk about trap, simply, to understand trap, what you need to think about is, trap is something like, see, I want to be a buyer here. So will there be a lot of reasons for people who follow conventional technical analysis people who follow conventional technical analysis, that they start selling when the prices comes into the zone? So that is what trap basically means, right? An area where we are trying to buy, majority of the people should be selling, and similarly the area where we are willing to sell, a lot of people should be willing to buy. That is what will act like a trap. All right, let's see. Extend discount to the channel, YouTube, advanced. All right, thank you for. All right, great. So happy to know that is helping you. What if we use 75 minutes chart instead of 60? Many times 15 minutes is equal to 60-minute results. See, the fact is, at the end of the day, it doesn't matter whether you're using a 5-minute chart, 15-minute chart, 60-minute chart, 75 minutes chart. uh, the end result is, the thing has to match with your trade plan. Whether you're using 60 or 75, you will still get some trades, you will still miss some trades. I understand that when it comes to NSE, the last candle is not a 60-minute candle, but now the problem is, if you start using 75, how many of you might be having a trading platform where by default you have a 75 minutes chart? Even on trading view, on a free account, you can't have these customized time frames. So time frames, yes, have their own weightage, but other than time frames, if the trade plan does not match, if the trade setup does not match with your trade plan, irrespective whether you're using 5 minutes or 75 or 60, it's not gonna help, right? So you have to give more attention to what is in sync with your trade plan versus the time frame, right? So that will be much more important. All right. So how can we get access to some of the Excel files on your site? As an example, the so it is a free Excel sheet which can be downloaded. Probably you didn't click on the download button. Once you click on the download button, you should definitely be able to download it, right? It's not locked. The IV Excel sheet, especially if you're talking about. All right, so thank you for having made this course free as well as live sessions. Have learned quite a bit and my confidence is growing. All right, good to know. And I hope it is also giving you the desired results you're looking for. So again, thank you everyone for joining in. I will be seeing you now next weekend. Till then, trade safe. Enjoy your Sunday. Take care. Bye-bye.